Big data on Friday with non-farm payrolls coming in pretty strong. Biggest words I've seen to describe this was wow, simply put. Now we have more data hitting on Wednesday. This is inflation. Everything is sort of working together. I wanted to break something down, give you an idea as to what's going on, what's driving inflation, how this all breaks out. I've got a few charts and expectations moving forward. I've been saying for some time now that inflation will remain higher, and because of that, interest rates are going to remain higher for longer. Initially, bond yields spiked higher, but then sold off. That pushed stock markets, which initially, on the news from non-farm payrolls on Friday, dropped stocks, but then rallied. So what's next? What do we expect on Wednesday coming up and in the future? Let's jump in. I got a couple charts I want to break down for you. First and foremost, thanks for stopping by. I've got links down below for my new channels that I'm starting. This channel is actually one of my new channels. I broke some things out from my original channel. Those links are below, so if this is the kind of content you're looking for, make sure you hit that like and follow button. I am an economist, and I look at everything from an economic standpoint. Our economy is about 72% consumer-driven services. From that, if you follow the consumer and their income or rate of growth of their income, you can follow consumption. If you follow consumption, you can see what will happen with revenue for companies and inflation. These are the things that really kind of drive our economy. And the first thing you need to understand is personal incomes drive personal expenditures. And I look at things from a rate of growth perspective. If the rate of growth of personal incomes is increasing, so will the rate of growth of personal expenditures. Now, personal incomes kind of encompasses two things. First off, how many people are increasing their revenue via more people coming on to the payroll system or higher pay in general. Those two are the factors you need to understand. But personal incomes drive personal expenditures. From that, personal expenditures drive business growth, and personal expenditures drive employment and then inflation. Now, how does that work? If all of a sudden the consumer just choked out, businesses would have to respond. They'd have to lay people off, which would perpetuate that choking out. And inflation, because less and less is being consumed, tightens up and inflation drops. So if you follow that concept, the reverse is true as well. If consumers begin to get their incomes increasing at an increasing rate on a year-over-year basis, that income growth will drive future expenditures. Businesses will respond. They're going to see their shelves getting shorted. So they're going to ask for more inventories, whether that be from manufacturers overseas or however they do that process. This starts the business cycle, but that demand cycle begins with the consumer. So you really have to kind of pay attention to what's going on with the consumer at any particular time. Here I have two charts, personal income versus personal expenditures. And as you can see, there's a pretty tight correlation, although there's some variations here and there. And oftentimes that has to do with outlying effects such as inflation or some other aspects such as maybe housing or things like this. But generally speaking, since 1990, if you kind of look at this, you can see that personal incomes moved in a certain direction, and generally speaking, personal expenditures followed. Unfortunately, the charts got blown out of the water with COVID and the shutdowns, because what happened was we saw a big contraction, and then we saw the federal government giving away money, which was considered income. Now, unfortunately, when you're looking at this chart, as you can see, COVID really kind of blew things out of the water. It made it distorted for various reasons. We weren't steady as you go, steady as you go, steady as you go when it comes to these charts. We saw an immediate contraction of employment and expenditures, but then we saw a big spike in income because of the stimulus checks by the government. So it really has kind of distorted these charts out a little bit, but we're starting to get back to more normalized views on these charts. But let's move forward. I want to show two charts. This is personal expenditures and the PCE deflator. PCE deflator, of course, is an inflation number inside personal consumption's economic release. And if you look really close, again, you can see that things are a little distorted towards the end, but generally speaking, expenditures drive inflation. And the reason is simple. As consumers' income grow, so will their expenditures, and then from that, they will start to drain stocks for businesses. And those businesses have to kick up, and this pushes up demand across the board, and inflation will start to follow. Now, here's the same chart, and if you look at this chart, it is, we are seeing, this is the same chart, but I've kind of expanded it a little bit for you. It's the same thing, it's just, I kind of made it a little wider. We're seeing expenditures and the deflator moving back toward normal. Now, expenditures themselves, the blue line is getting a little closer back to normal, but PCE deflator is still way out of line. My expectations have not changed whatsoever. That inflation is not going to magically hit that 2% rate. Yes, it's declining. The rate of growth is declining, but we're still nowhere near the 2% target that the Federal Reserve would love to see. We're likely to see, if you saw the previous charts on personal incomes, it's increasing as well, although the rate of growth is slightly declining. Still, we're getting more to normal. The deflator will likely continue to move in a sideways to lower number, but it will take a while until we get to that 2% level. And that's really kind of the key to everything. So this week we've got inflation coming in, and inflation numbers are probably likely going to continue to show that there's some sustained numbers higher. The headline will probably move a bit higher, but the core rate will probably slide a little bit. Sounds great, but incomes and expenditures are moving higher. Therefore, this is going to be a very long process. Inflation itself will continue to move lower and lower and lower, but at a very sluggish rate. So coming into this Wednesday, I expect we'll probably see inflation numbers coming in about similar to what we saw with the CPI just a couple weeks ago, or the PCE and the CPI coming in about the same, but the S&P 500 may actually start to rally again. Simply put, bond yields might have peaked out a little bit right around this area, and we might see some congestion sideways. Bond yields have been racing higher, and I expect that'll probably moderate out a little bit. That it won't be for another 3, 4, 6, 9 months until we are solidified that that 2% target rate is going to take a long time to get there. So this week coming forward, I'm actually looking to go long into this economic release because I believe that it'll be a continuation of sort of moderation, and that the attitude is we're getting there, we're getting there. And there's no real sort of economic release out there that's going to push this in a way that will push the S&P 500 lower. That's more immediate. Long term, I expect the S&P 500, the SPX SPY Stock to slide a lot more compared to where we are. It's going to take some time. There's going to be shifts throughout the world with a lot of things going on. We now have 2 wars, war with Ukraine and now Hamas and Israel. That could blow up into something far bigger. We don't know yet. In the meantime, I'm looking for the S&P 500 to kind of bounce from this level. We've seen some serious selling off. The recent news over the weekend brought the S&P 500 down lower, and I expect that to kind of move back upward in the next couple of days, even with inflation numbers. Make sure you hit that like and follow button. I'm going to continue to break down what drives these economic data points so that you can get a heads up and get a sort of ahead of the curve. Look for moderation in the inflation number, bond yields will relax a little bit, kind of move sideways, and because of that, that will be a go for the S&P 500, the SPX SPY Stock. Make sure you hit that like and follow button. Follow the links below to my other channels. We'll see you in the next video.